So let's get started on this tax strategy because you've probably seen these type of videos all over social media. If not you, maybe your client, this one here. Hire the kids. And these videos always have an amount on there. So your client usually comes in, walks in and says, I need to hire my child and I need to pay them exactly a round number or an amount that's what you know of as the standard deduction. But before we do that, we really need to understand the law behind that. And that is where we're going to start on our session today. But before we get into our session, if we have not met before, I am so glad you're joining us today and you're getting to know the inner circle. We are a community of online that has tax pros where we support each other because we champion respect and knowledge sharing and supporting each other in our growth in this tax journey. My name is Nadia Rodriguez. I am based out of Dallas, Texas, and I have been in practice as a CPA for over 15 years. Just recently, I left my corporate job and I've been doing this full time, both running the Nadia CPA Inner Circle, my tax training academy that has advanced courses, and also my tax practice. But I'm also a mother of two. And this is why this strategy really brings me a lot of passion because the older my kids get and the more expensive they get, that's where we start looking into how can we reduce it? Where's on in the law? Are we following the law? And is there a way to help us reduce our tax burden? So with today's session, I want to make sure that you walk away and that you're able to identify who qualifies to implement this type of strategy. Yes, anyone can hire their child if you have a business, but where does the strategy come in to save in on the tax dollars? And then distinguish between what legitimate work can we do for our have our child do versus what just doesn't seem very reasonable or very believable. We need to understand the age and the wage limitations of our child because, yes, our child, can we hire them as newborns? We're going to talk more about that. And then, of course, evaluate which type of business. Yes, I'm running a business, but not all business entities qualify for the tax strategies. Again, every business can legitimately hire anyone, including your child, but where the tax strategy lies depends on the type of business entity that you have. And then we're going to recognize those common compliance pitfalls. Because, yes, if we're learning about these strategies at the end of the year or maybe the year after, can we go back and implement those strategies? We're going to talk about that. So, yes, these are just a couple of screenshots. It took me maybe 3 seconds to find a video where I just typed in hire your child. There's thousands of videos out there that you probably seen or your client has seen about the tax strategy and how you pay no income tax when you pay your child in your business. Now, I did see one that talked about having an LLC. Open an LLC and have your child open an LLC so that there's no tax. We're going to talk about that. But let's start at the very foundation. FICA. Does anybody here know what FICA means? If not, I have spelled it out to you. Nobody calls it by its long name of Federal Insurance Contribution Act. We just know it as FICA, which FICA is the mandatory tax that we all have to pay, and it funds the Social Security and the Medicare funds. We see here the responsibility. If you are an employee and if you're an employer, what type of responsibility do we have mandatory to pay on into these funds, into the Social Security and Medicare tax? We know that the employee pays 6.2% of their wages into the fund for Social Security, and the employer matches that 6.2%. Medicare, it's 1.45% of the wages, and then the employer comes in and matches that as well. So if you add all of this up, in total, it's 15.3% of FICA taxes that have to get paid on your wages. Now, we do know that this is only related to the wages, to the earned income, that you're doing something to earn that income. Employers and employees share that burden, right? You cut that bill in half, the 15.3% gets divided in half. But self-employed individuals, we have to pick up 100% of that bill. We don't have an employer. We are really wearing the hats of everything, right? We're the employer, the employee, the marketing person, the social media, the tax, we're everything. We are self-employed. We have to pay 100% of that, 15.3%, and we pay that with Schedule SE on our tax return. So we know FICA, it's not optional. Even family employees, if you do employ family, they are subject to the FICA. They are your employees, whether it's family or not. But if it's a family member, they have to pay the FICA and you have to pay the other half unless some exception applies. And this is what we have with our Internal Revenue Code, the tax law. There are so many sections in our tax law that do say the general rule everyone has to pay FICA except if. There are a lot of exceptions, which really gets us into the tax strategy part of our tax law. So we look at Internal Revenue Code section 3121, which specifically talks about the employment for FICA tax purposes does not include any services that are paid for a child under the age of 18 by a parent for a child. And so this is where the exception lies in. This is where the tax strategy says that general rule, you have an employee, you have to pay half of their FICA, except if they are your own child under the age of 18. Now, a lot of the questions come is, well, how about if it's my niece? They are under 18, or my nephew, someone that's close to me under the age of 18. This only applies to parents and their direct child. Cannot be a family member other than their child, where you get to enjoy this tax strategy of being exempt from paying FICA. Then we also have FUTA, which is the Federal Unemployment Tax Act. Again, this is a mandatory tax that employers have to pay. It's only employers that have to pay, not the employee, for funding that unemployment compensation. Somebody gets laid off, loses their job, as an employee, they have the right to go into an office and ask for unemployment compensation because their employer has been funding that unemployment compensation act. Now, only the employer pays the FUTA, and it's 6% of the first $7,000 of each employee's wages. So yes, the employee could have received the salary from you as the employer for $100,000. Only the first $7,000 is what we have to pay as employer a FUTA tax. Now, Section 3306, there is an exception. Earnings paid to a child that is under the age of 21 while employed by their parent does not have to pay the FUTA. The employer doesn't have to pay that FUTA tax. So if you think about it, anybody that's 18 and or that's under 18, not 18 and under, but under 18, the employer does not have to pay FICA. That was half of the 15.3%. And they also don't have to pay the FUTA. Now, when we're talking about FICA, the 15.3%, half of it gets picked up by the employer, the other half by the employee. But the responsibility lies on the employer to withhold the FICA. That's not going to apply anymore because they are your child. So that is a savings of that 15.3% for both sides because they are your child. Now let's talk about federal income tax, because we know that when we earn income, we have to pay 3 taxes. We have to pay Social Security tax and Medicare tax, which if you combine them, they're called FICA. And we also have to pay federal income tax. So out of those 3 taxes, we can see an example here for just federal income tax. We're not talking about state tax. That's a different level. If you do live in a state that does have a state income tax, that's a 4th tax for you. But when we're talking about federal tax, we see an example here of just gross receipts. Let's say this taxpayer is single. They received $15,000 for the entire year on their gross revenue. That's all the income that they earned. And we know that the tax return, if we're going down a tax return, we get to deduct some adjustments. And then we have our AGI, our adjusted gross income. From that amount, we get to deduct our standard deduction. For the year 2025, for a single person, that's $15,750. At the end, this taxpayer here has no taxable income. There is no tax liability because they're earning less than the standard deduction. So this is where the tax strategy lies too, not only on the employer side, but also the employee side when they are a child of a parent for the business. We see FICA again, it's not owed by the employer or the parent. The child does not have to pay it either. They're exempt. Both sides are exempt from that, remember, 15.3%. And in the FUTA, it's not owed by the parent. The child has never had to pay it anyway. They're an employee, but the parent no longer has to pay that 6% of the first $7,000. And federal income tax, the parent, you are still able to deduct that wage expense 100%. It's a business expense. But does anybody get to pick up that income? The child picks up the income on their tax return, but it's tax-free if it's under the standard deduction. And that's where the tax planning comes in. If you are paying your child and at the end of the year it was less than the 15,750, it reduces their income by that amount and there's no more tax due. However, we have to be careful. Not every business can take advantage of this type of tax strategy. You can employ your child legitimately, but in order for you deducting the wages and also employing the FICA and FUTA exemption, you have to be only a certain business structured at a different time. So let's look at what type of businesses qualify for this type of strategy. You can't be incorporated. You have to be unincorporated. So sole proprietors that have the Schedule C, Schedule E, Schedule F, as long as they are not a corporation, because if you are a corporation or you are legally as a partnership, not in a community property state, then you no longer qualify. So this is where we're talking about sole proprietors. If you're a DBA, even if you haven't registered with your county as a DBA and you're just running your business, you qualify. How about an LLC? You took the extra steps to go register at your state as a formal LLC. Will you qualify? Yes, you do, only if you are considered a disregarded entity for federal tax purposes.
Nadia, sorry to interrupt, Nadia. Your audio went mute.
Okay. I had some really good information I was sharing right there. So what was the last thing you heard? Did we get into did you hear me at this slide at all? I'll redo this slide.
Yeah, it was about 10, 15 seconds of a mute.
Oh, okay, that was strange. It must have been the clicker. Okay, let's go from the beginning. And sorry if it's repetitive, but the more repetition, the better we'll get this, right? We're talking about your business cannot be incorporated. So if you're a DBA, sole proprietor, either DBA or just are doing business, you qualify to implement this type of strategy. If you're an LLC, it has to be a disregarded entity LLC for federal tax purposes. And what do we know about LLCs that are formed by only one person? You're disregarded. If you haven't elected to become a C corporation or an S corporation, you're a disregarded entity on your 1040. If you are two members, only husband and wife, and if you are in a community property state, there's 9 of them. Texas is one of them. I believe California, you're also a community property state. If you're husband and wife, you are considered, per the IRS, a disregarded entity. And you're filing your business income and expenses, most likely on a Schedule C, or if you have a Schedule E for a rental. If you are a partnership, if you have formally come together and formed a partnership, or you are in husband and wife in a not community property state, you are considered by default, according to the tax law, a partnership. So if you are a partnership, the rule says that both of the partners or anybody that is a partner in that partnership has to be the parents. So it can't be both parents being the partnership and then maybe they invite a third parent that's not related to them, or even if they're related. The entire partnership itself can only be owned by a husband and wife. So these are the rules. You have to define that employment relationship and the compliance standards with your child. Because why? The IRS is going to really take an extra look at this. And I think their focus is going to be a lot more now that social media has been a thing and these type of strategies are just getting thrown left and right. And only the general rule talks about employing your child. The IRS is taking a closer look at that. Because why? It's really you're shifting your income down to your child and you're receiving a deduction. You're not paying the payroll tax. Your child isn't paying any kind of FICA. There's not any kind of money coming to the IRS, so they're going to take a quick look at this. A more closer look is what I mean. So yes, they're taking a close look if these are their wages paying to a child because they are part of a family. So we know that sometimes we can be biased with our own children. But we need to be careful on the type of work that's being performed by the child. It has to be first a bona fide relationship, which means it's a relationship that you would have had with any other employee in your company. They still have to show up on time, whatever compliance standards, employee conduct that you are championing for your other employees, your child also has to follow that. It has to be directly related to the business. Example, you're running a landscaping business. You can't say that your child is helping cut hair at a salon. That has nothing to do with your business. So you do have to find duties inside of your business structure that your child can perform. The wages have to be comparable to what you would have had to pay anyone with the same skills as your child to perform the work. You can't just magically say, I will pay you $10,000 to scan my receipts. It really has to be, how did you come up with that amount? The hiring age and the legality. Now, this is more looking at each state by state because every state has their own child labor laws. Some states are very strict that say you cannot hire anyone under the age of 15. Other states like Texas have rules like that. You cannot hire anyone under the age of 15 unless they are your child. So yes, parents can hire their children at as young as maybe infants, where I have heard the strategy of having your infant child maybe for their marketing flyers. When it comes into those kind of areas, I don't really like to do those kind of areas unless I have a client that is selling baby clothes or maybe baby products, then that is completely understandable to hire a child that young to be the model of the product that you're selling. At that point, you need to do your research, you as the employer, the business owner, of how much are baby infants getting paid for these kind of modeling gigs. And so that's where it comes into, how is this child benefiting the business? How are they? Is it because the child is there, now business is booming? It really has to be more of take a step back and how do you see yourself defending this case against the IRS? So, yes, look at your state compliance to see if first your state respects any type of age for hiring children when you are the parent. And then, can the job duty be done by the child? Also, look into that because, yes, maybe they can be very young and you are able legally to hire them in your state. But if you're giving them very intensive labor work, or you're saying at least on paper that they are maybe helping you move, maybe you have a moving company and they're helping you move really heavy and carry heavy boxes, a 4-year old, that's not going to be very believable. Again, we have to really pay attention to what they're doing. Scanning receipts can probably be done by young kids this day because they're really good with their phones. I will tell you, my child, we have two. My 12-year-old is the one scanning my receipts and even doing stuff on spreadsheets. I've taught her how to use the spreadsheets, how to do some categorization. And yes, these kids are nowadays are very good with computers and learn pretty fast. Just really make sure that you really are training them and they're able and capable to do the job that you are describing, that you are paying them for. And how do we prove all of this job related duties and that employee and employer relationship? You have to complete the W-4. They are still an employee. Now, can they, sign the W-4, really provide information themselves, especially if you're hiring them as the model, the infant model on your baby clothes ads? Probably not, but still have some kind of method on who's gonna represent this child. Are they the ones who is it the other parent that legally represents them in all kind of business affairs? There has to still be paperwork, no matter how young the child is. So yes, the W-4 has to be filled out, the I-9 has to be filled out and at least kept on record. So if you're not going through a payroll company and you're doing this all yourself, make sure that these records are kept in place. You're providing the IRS with a W-2 at the end of the year because you need to let them know how much of a wage expense you had that now your child is going to pick up on their income tax return. You have to do the payroll tax filings as well. You have to create that job description. Now with AI, that is so easy to make and just describe really what your child is helping you with so that they can help you with a job description that you print out and you have an employment contract as well. That employment contract, have your child acknowledge it, sign it, even if they don't have a formal signature, have that relationship. And not only with the IRS compliance, which is the most important thing for our tax strategy to stand in place, but also your child starts to get that responsibility of what happens when they get hired by someone. Keep records of the days and the hours worked. Keep timesheets. I know this is sometimes a drag, especially asking our kids, 12-year-olds, 10-year-olds, to do a timesheet, but it's really getting them used into the habit to doing this. Because the last thing you want to do is recreate records at the time of audit. And I'm going to go over a slide that does prohibit that. Always pay the wages with a check. Now, I know nowadays, no, not that many people use any more checks, but if you are doing a bank transfer, I have here that at least you have a document that backs up the exact amount that you're transferring over to your child's bank account. It shouldn't be round numbers. Maybe you are paying them an exact, maybe salary is what the contract says, or maybe it's an hourly wage. Remember, the hourly wage, the salary wage amount has to have backup on how the employer came to that reasonable amount, because it's going to be a reasonable amount that would have been paid to anyone else with the same age for the work and the job duties that your child is performing. Again, check with your state if your state requires any other documentation. What I just went over is what federal government, the IRS, is going to ask for if there's ever an audit, if there's ever a question. This is the type of record they want to see. What about your state? Is there anything on their side that they're going to ask for? Check with your state agencies. Now, federal income tax withholding, the W-4. Yes, they still have to complete the W-4, but they might be exempt. They can probably check the box that they are exempt from any type of withholding if they had no liability last year. Maybe you are their first employer and they've never had to pay any federal income tax on any kind of wages or any kind of income that they earned. And also, they expect to receive none this year. Now, this one's a little bit tricky because what I do is you don't want to start paying your children with the number in mind, which is the standard deduction. You really want to start with, I am going to pay them $12 an hour for this type of job, or any kind of either hourly rate or the salary that you have decided to do. Mid-year, if you see that they're getting close to the standard deduction and there is no other way that they're going to be able to reduce that income, at that point, my child would have to fill out another W-4 and remove themselves as exempt. Now I will start withholding income tax on their salary, on their hourly wages that they get paid. So that's where the tax savings comes. Let's really dig into more utilizing the standard deduction. We did see that if you have a child that is receiving wages from you, we know that the standard deduction for the year 2025 is $15,750. I do tell you with caution, do not hire your child for exactly $15,750. We saw those TikTok screenshots of the social media videos where they're suggesting an amount very close to the standard deduction. Honestly, if at the end of the year, coincidentally, the hourly rate and the time that was entered came out to be $15,750, you at least have the backup for that. But I will tell you, this is more of a, if they're getting close to the $15,750, give them a Christmas bonus, because I don't want to raise any flags with the IRS of, am I paying them exactly the $15,750? Because what happens, my child is going to file a tax return and have $15,750 of income, a deduction for exactly that amount, no tax liability, no tax due. So yes, I do not want to bring any kind of red flags for that. The other strategy that comes through is the bracket shifting, right? You're receiving a deduction at your tax level, at your tax bracket level, a deduction for the wages that you're paying your child. Your child is then picking up that wage at their lower tax rate, especially you're not paying them exactly what you are making in your business. So yes, we're shifting that over to their income tax bracket, which is most likely lower. Now, if we want to take it a step further and we want to teach our children the retirement savings plan, We want to really start teaching them financial planning. This is where they can then become what you think like our client. We can advise them now that they are receiving wages, they are receiving a pay for the work that they're earning. It's never too early to start saving for retirement because we know that they can start contributing into a traditional IRA. The rule is that you have to have earned income to start contributing to a traditional IRA. So, yes, if we see in 2025, you can pay your child, combining the standard deduction of $15,750 plus the maximum IRA contribution of $8,000. It's really $23,750 of a tax-free wages earnings for your child. The one that I prefer, honestly, is a Roth IRA. Our children. Oh, sorry. One moment. Sorry, my phone was going off. The Roth IRA is really my preference. I'm not sure if anybody here in chat has looked into the Roth and the amazing savings. The Roth, you contribute into it. There is no tax deduction at the 1040 level, but instead your income will grow tax-free. And so that's the beauty about the Roth. The child, at the time that they start working, they're going to be taxed at a very low tax rate. So, yes, even if they don't receive a deduction, hey, pay the tax at your lower tax rate on those earnings and go ahead and fund a Roth IRA. Now, for audit red flags, what do we need to look out for? Contemporaneous documentation. This is what I was talking about. The law says that we are supposed to have documentation at the time it happens. The biggest example that I can think of is mileage logs. We are supposed to be tracking our miles and keeping up with that mileage log as it happens, not at the end of the year or when it comes to tax time. The IRS is requiring this, and we do know that records must be created at the time of the event, not reconstructed after, especially during an audit. That is against the law for us to do. Now, examples of what the IRS is going to ask for when it comes to paying your child any type of wages out of your business: timesheets. How did you come up with the amount that you came up for the biweekly payment? Or maybe you're paying them every week. Where's the time log? Where's the employment contract? Where are the payroll reports that we were actually doing this how we were supposed to? And this wasn't just done for purposes of saving on tax. When your salary equals your standard deduction for your child. Paying the child exactly the standard deduction amount, again, can raise IRS suspicion that really you are not paying for the job that was done, but instead this was motivated by tax savings. And that is not something that we want to get into. But we have the backup by all of the proper documentation that we are not doing it just only to receive the benefit. Yes, the tax savings benefit is a great benefit. And if we're going to structure it around that, make sure that you have the documentation for it. Planning this going forward. Of course, in your own business or in your client's business, start finding any kind of duties that your child can do. Of course, it has to be reasonable duties, right? Somebody that their age could be able to perform for you. Any type of due diligence, go ahead and do that with the work that is being performed. Document it, have employment contracts, have those viable documents that will stand up in case it's ever questioned. And have your child pay their own expenses. This is where the planning comes in. Maybe you start suggesting for them to start opening their retirement account, but also start paying for your cheerleading practice, start paying for those extracurricular activities that most likely are coming out of your pocket to pay for those dues for the sports. Because not only are you shifting down that income down to them, they're able to, at their tax rate, be able to pay those personal expenses. And you teach them young. You teach them financial responsibility at a young age. I'll tell you my personal experience, and I know George is here to witness and testify this, but for sure, hiring the kids, my own kids, I would say they are not the best employees. Patience is required when you hire your child, but always think and always know and recognize the tax savings that comes from it. And yes, one day, hopefully, I'm hoping that they appreciate the financial responsibility that we're teaching them. But yes, there's always something in your job that your child can do. Even if you're not in the business of tax preparation or bookkeeping, and you have clients that are in the business that it's labor intensive, there has to be paperwork that probably has to be filed. There probably has to be receipts that need to be scanned. There's something that that child or their children can actually help you with, especially if you have more than one. Find duties for each of them. Again, this is more about tax savings, showing them financial responsibility, and most importantly, keeping our documentation and records on file.